In the world of stock markets, not every IPO creates buzz, but every now and then a name comes which gets serious attention, and this time it is HDB Financial Services. Now, why this IPO matters is because it's not just any other finance company. It is a subsidiary of HDFC Bank, one of India's biggest private banks. The IPO is being seen as one of the biggest events in the NBFC space this year. The company is looking to raise rupees 12,500 crores, making it the largest NBFC IPO of 2025 so far. But here is what investors should understand upfront. Out of that total size, only rupees 2,500 crores is actually fresh capital going into the company. The rest, rupees 10,000 crores, is HDFC Bank offloading part of its stake. The price band is set between rupees 700 and 740 per share with a lot size of 20 shares. And for those who already hold HDFC Bank shares, there is a reserved 10% quota in the IPO. So if you have shares in your demat account as of now, you can apply in retail as well as shareholder category. Coming to what HDB does. At its core, it is a non-banking finance company which deals in enterprise lending, asset finance and consumer loans. It also earns some revenue from distributing insurance and running bank office services for HDFC Bank. With over 1,700 branches, mostly in smaller towns and rural pockets, it is catering to that underbanked India which still does not have easy access to formal credit. However, HDB is still a relatively small player with just 2.2% market share. Financially, the company has been consistent, if not spectacular. Revenues have grown from rupees 12,400 crores in FY23 to about rupees 16,300 crore in FY25. That is a healthy trend. Profits have also moved up slightly from rupees 1,959 crores to rupees 2,176 crores. But the quality of those earnings is something to watch. Return on equity has slipped from 18.7% to 14.7%, and net interest margins, a key profitability indicator in the lending, has also dropped from 8.25% to 7.56%. Add to that, around 27% of their loan book is unsecured. That part is always a bit risky because when the credit cycle turns, unsecured loans are the first to default. Now, when we look at valuations, the stock is being offered at 3.88 times its book value at the upper end of the price band. That is somewhere between a premium player like Bajaj Finance and a lower priced one like L&T Finance. The pricing here is cautious. In fact, it is 42% lower than HDB's valuation in the unlisted market last year. That could be a smart move to pull in more retail interest, especially since investor excitement around IPOs has cooled down compared to last year. But not everything is perfect. One concern is the heavy offer for sale component. Most of the money raised is not going to the company, so growth capital is going to be limited. Second, there are regulatory overhangs. The RBI could eventually ask for more stake dilution due to overlapping businesses between HDFC Bank and HDB, especially now that both operate in similar verticals. And third, with such a small market share and high unsecured loan exposure, HDB still has to prove it can scale safely in a very competitive NBFC market. So the big question is, should you invest? If you are an HDFC Bank shareholder, the reserved quota definitely makes it tempting. One of the most trusted institutional investors in India, LIC has pumped serious money into HDB Financial's IPO as an anchor. LIC does not chase hype. It usually enters when there is long-term conviction, pricing advantage, or strong backing, in this case from HDFC Bank. But what does LIC see that retail investors might be missing? Is it the rural branch network, the NBFC sector tailwind, or just value at a discount? Because if the smart money is moving in, it is worth asking, is this a safe long-term entry point or just another average listing? But for everyone else, it really comes down to what kind of investor you are. If you're looking for a safe bet just because of the HDFC tag, this is not that. It is not a bad company, but it's not a high-growth rocket ship either. It is a middle-of-the-road play, steady, cautious, and maybe a little boring. And sometimes boring is fine, as long as you know what you're getting into. So weigh your risk appetite, think long-term, and if you're interested, apply. But apply wisely.